Hello, very good evening to all of you. Greeting to all. Am I audible? Please give me confirmation so we can start today's session. Screen is visible to you. Voice is okay. Very good evening to all of you. Greeting to all. Am I audible? Okay. Voice is okay from my side. If you find any disturbance, so let me know so I can solve this. So greeting to all of you. Welcome to Global Online Platform. So here Dr. Swati is here. Today's the students who are preparing for the UGCNET June 2025 preparation, especially for the Commerce and Management subject. As you know that we are running over here 15 days strategy for your Maha marathon session, and as you know that whatever the questions we are taking in this Maha marathon sessions are most expected questions that we have expected to be asked in your June attempt, your June 2025 examination. Okay, so here we are going to discuss the fastest revision of all the questions of all the units. Okay, so this is our day 11. Okay, so let's begin with the first question which is in your screen. I am expecting that you are reading the questions carefully, understand the concept, and mark your questions answer, and you have to write it down your answer in a chat box so I can understand which concept your is weak and which concept is your stronger. So according to that I can explain each and every things in a detail with you. Okay, so let's start with the first question. Okay, first question is which is in your screen, that is, which of the following is not a contingent liability? Again I'm reading this question. Which of the following is not a contingent liability? Before you know the answer this question, if you very well aware and very well informed about what is the contingent liability, so you can easily mark this particular question's answer easily. Okay, you answered the question for this question easily. Okay, so is not that means from all the options one of the option is not a part of, it's not a, we consider as a contingent liability, but other three options are the part of your contingent liability. So I'm reading options, and till you have to mark your answer. First option, uncalled capital on partly paid up share. Option B, debt include in sundry debtor which are doubtful in nature. C, claim against the companies cannot acknowledged as a debt. And D, liability on bills receivable previously discounted. So student, you have to mark your answer so I can explain the concept in detail. Okay, contingent liability, this kind of liability which company is not consider as a regular liability. This liability occur in front of company or in front of firm or the organization which is unplanned. Okay, so this is now according to this liability is called unplanned liability. Okay, so here first option, uncalled capital on partly paid up share. So uncalled capital on partly paid up share, this is also called as contingent liability, because it can become a liability if company make a makes a call. Okay, so that's why this liability is paid up by the company when company make a call to that party, to the shareholder. Only in that condition this will be happen. So that's why this is we call, if the company may not make any call to a shareholder, so this liability will not be considered in our liability section. Okay, so this is why this is our contingent liability. Okay, moving toward the next option, that is debt included in sundry debtor which are doubtful in nature. Okay, actually debt including sundry debtor, as you know that sundry debtor is not our liability, it is our asset, it is our current asset. So how do we consider this debt into a current liability, isn't it? So that's why this is not our, sorry, this is not a current liability, is it? It's not liability at all. It is our, we consider this date when dates is including sundry debtor and which are having a doubtful in nature. There is no specific, we are not sure that this date we will get back from this debtor or we are paying. So in that condition, this is what, this is, we also said this is a potential loss, or we can say the asset is at a risk. Okay, so this is not liability. So if it is not a liability, so we cannot took into the contingent liability, isn't it? So this is option is wrong. Then moving toward the second C option, claim against a company cannot acknowledge as a debt. Claim against the company is not acknowledged as a debt, so this is your contingent liability, because actually these are whenever the company claim against acknowledged as a debt, so this is you can say this is a classic contingent liability, because company might be liable if the claim is unheld, only in that condition. Understand? Now moving toward the option number D, that is liability on bills receivable previously discounted. So as you know that bills receivable, we write it down in the current asset side. Okay, but again they additionally mention that previously discounted. So if the bill is dishonored, previously discounted, that means if the bill is discounted, it means that that particular bill is discounted in the bank. But there is a chance that if the bill is dishonored, the company has to pay to the bank. Okay, so it is, we also called as contingent. We can categorize this also in the section of, or in the form of contingent liability. Okay, suppose I will explain it in with example. Suppose A and B, these are the two person, and A make a bill on the B. Okay, so here A needed a sudden A needed urgent need of money, he needed. Okay, but he discounted into the bank. Okay, and he get a cash from the bank. Okay, but somehow, or we can, this conditions happen over there, that is B has dishonored. So in that condition, B is not liable to pay back to the bank. Here this is a responsibility of A to pay to the bank. So this is a responsibility of a company to pay to the bank. Okay, so this is what actually the option number D is talking about. Okay, So option number A, B and D are the example of the contingent liability, but the option number B, it's not a part of contingent liability. Actually it is a part of your current asset, because debt is included in the sundry debtors, okay, and which are doubtful in nature. So first of all, this is not a liability, isn't it? Here we can, if it is having the doubtful in nature, so it we consider as a potential losses suffered by the company, not a liability, because in this we have the our debt, our assets are at risk. Okay, so that's why option number B will be the right answer for this question. Understand, if you do not understand any concept, please let me know. I'm continuously checking your chat box. Okay, then students, I am here with a Global Online. On behalf of Global Online, I am here with a new batch which is started from the 5th of May, and here you will get all your complete package of UGCNET June 2025 preparation at only rupees 8,000. If you register yourself for the paper 2, so here you will get paper 1 free of cost for you. So this is a golden opportunity, student. What you will get over here, you will get over here daily live lectures, recorded sessions, okay, complete syllabus notes in PDF format. Okay, here I am completing 100% syllabus with a live session, okay, and along with that I am going to be cover over here complete revision with the help of PYQs and analyzing these 13 years PYQs. I made every, that means Maha marathon session which I am running over here. This I have made most expected MCQs, and I'm taking this most expected MCQs as a revision. So here you are completing your syllabus along with the revision of your all PYQs and all your most expected MCQs. Okay, and here you will get full syllabus mock test, 4000 MCQs with detailed explanation, PYQs with detailed explanation. And as you know that if you register yourself for the paper 2, either for the commerce and management, you will get complete paper 1 free of cost. Okay, so this is a best opportunity for you. And if you have any query, if you want any discount, so this is actually the final discount, but if you have any query, you can get in touch with this WhatsApp contact number. Okay, how to download the Global Online? You have to just go to Google Play Store, then register with your mobile number. Okay, and you have to go to the my course section, then you have to search that course, whichever the course do you want, and you have to register. Once you register, you will get all this unit wise folder, and this unit wise folder you will get recorded session, live session, mock test, unit wise mock test, and the content. Okay, and also we are adding you all of you in the WhatsApp group, so it will be easier. And in this WhatsApp group, we are continuously sending you the content, PDF notes. Okay, and all the PYQs and most expected MCQs. Okay, this is not only for the paper 1, this is also for the paper 2 also. Okay, the next question, that is question if if next question which is in your screen, student. It is better to be present in the live session, because every day you are going with a live session, so you can ask the questions, so you can clear your concept. Okay, so be active in the live session. Okay, so moving toward the next question, that is if goods worth rupees 3210 return to a supplier okay, and is wrongly entered in the sale return books of rupees 2310. So there is a mistake is made by the supplier, because in the sales return book he make a wrong amount, he enter the wrong amount. So what is it, what is the exact impact on your gross profit? So because your reduce your sales return amount, so it will either it will affect to the profit, gross profit. Either the profit is increases by the 6420, either the profit is decreases by the 5500, gross profit increase by the 5520, and gross profit will be decreased by the 5520. So how do you get this? So here you know that is wrongly entered in the sales books, the amount is 2310. So first of all, actually the purchase return is not recorded. Understand, here if the goods worth rupees 3210 return to supplier, that means he returned to supplier, that means first of all he make a purchase entry, purchase account debit to cash account, like this. How much? 3210, 3210. But per now he was to return it, so cash account debited to purchase return. Okay, so what entry he made? He wrongly made which entry? He made an entry 2310, 2310. Okay, so here purchase return is not recorded, and this purchase return amount is actually the purchase return entry amount is 3210, 3200. This is a purchase return amount. Okay, and these expenses overstated to 3210, and sale, so they are not make a entry on purchase return, they wrongly enter in the sales return. So what is the entry of sale? Cash account debit to sales account. Okay, and what is the sales return? Sales return account debit to cash account. Okay, this entry we generally made, but he do not make a entry in purchase return. Actually entry is this, but he wrongly enter in this entry. So what happened? And revenue is understated by, and what is it? He make a entry of 2310, 2310. So what is exact impact on the sales profit, gross profit? So here the here the purchase is overstated, isn't it? Because he doesn't make a return entry of purchase, he doesn't make a purchase return entry. If your purchase is overstated, it means that your gross profit is going to be seems less or decreases, isn't it? This is true. Are you agree with me? If your purchase is overstated, if your purchase account, your purchases, that means your expenses, if your expenses is looking higher in your debit side, so what happened? It's going to be impact on your gross profit will seems less, isn't it? So here by this amount is understated or less gross profit, we are seeing of rupees 3210. Okay, now the sale, this is what happened with the purchase. Okay, and he made an entry on sales return. So what happened in the sales return? Again this is understated sale, your also is going to be impact on your gross profit, because we sales return, from the sales we reduce a sales return, isn't it? Actually if I not make a, if I not wanted to reduce from the sale, so where I will write the purchase return entry in the expenses side, in the debit side, okay, of the trading account. Okay, it means that again my expenses is shown to be higher, and if my expenses is showing higher or the increases, here is increases by 3210 because I do not made a entry of the purchase return, and again I make a wrong entry on the sales return, and this sales return amount is 2310. It means that my expenses side of the trading account is increased by 3210 and is increased by the 2310. So when I add this, so my overall expenses side is increased by 5520, and if my expenses side shown is a higher, it means that it's directly affect to my gross profit, and my gross profit will be decreased by 5520. Understand? So here right answer will be option number D. Gross profit will decrease by 5520. Okay, understood? Anyone? Okay, moving toward the next question, that is, if debentures are issued at par, okay, at par, it means in a face value, okay, in a face value. Sorry, extremely sorry. Look over here. If the debenture are issued at par, face value, and redeemable at premium, that means more than your face value, isn't it? More than your face value. The journal entry at the time of issue will be, okay, so it's a simple question. What will be the journal entry at the time of issue of that particular debenture? Okay. Okay, so let it break it down. Let's understand this concept in a detail. When I'm talking about issue at par, the debenture are issued at par. In that condition, company receive full face value. Okay, suppose company's value of that particular debenture is 100. This is the face value. So it means that company receive full face value, that means rupees 100. Okay, at premium, that means company price that particular debenture at 150. So this is 50 rupees 50 is a premium value. Okay, so here the first thing, that is issue at par, it means company issue or receive to the capital reserve account. So whatever amount he is getting from reissue, that means he is getting the 40 rupees from reissue of that particular share, is not transferred to the profit and loss account, because actually it's not a profit. We cannot consider as a profit of the company. We consider this rupees as a capital. We transfer this to the capital reserve account. Okay, because this is a capital gain, not a profit, because somehow this amount is repaid to a shareholder in the form of dividend or to the payback of that amount. Okay, understand? So we cannot transfer that. But yes, this is, we can see here the company earned 20% the profit, but this is not we consider as a profit. We consider this as a capital gain. That's why we transfer that capital gain to the capital reserve account. Okay, yes. Then the next question, current ratio of company is 2:1. First of all, when I talking about the current ratio, what is the formula of the current ratio? Current ratio, current asset divided by the current liability. This is a formula. And if that current ratio ratio's value is 2:1, it means that the company's current asset is a twice when we compare with the liability, isn't it? Suppose, okay, and the working capital of the company is 1 lakh. What is the formula of the working capital? We have seen in the tomorrow session. Okay, working capital, current asset minus current liability, and that working capital value is 1 lakh. Okay, so what is the value of the current asset of that particular company? Isn't it? You have to calculate it. So how do you calculate it? First of all, they want to know the current asset value. Okay, so isn't it simple? Because if my current liability is X, then the current asset will be 2x. And if my working capital is nothing, sorry, actually there is a mistake. You have to keep in your mind, that is, he is only talk about the working capital, and your working capital is nothing but your current asset, and net working capital is equals to current asset minus current liability, and your working capital amount is already given to us, that is 1 lakh rupees, isn't it? And if it is 1 lakh rupees, you have to multiply with 2, because when I calculate with our current ratio, my working capital of that particular company is 2x, so you have to multiply with 2, so you will get 2 lakh rupees as a working capital. So the current asset of the company is 2 lakh. It's a simple question, but you have, if you are known with the words, if you are clear with your concepts, you can easily mark this question within a minute, within a second, not a minute. Minutes is, I said it too much, but within a second. Okay, so right answer will be option number A. Okay, can I move toward the next question? Okay, so moving toward the next question. When company operate at a break-even point, then its contribution is equals to, okay, when company operate a break-even point. Now what is a break-even point? A point at which your sale of the company, okay, and your cost of the company, that means total cost, is equals to each other. Okay, so when a company operate a break-even point, its contribution is margin, that means your from the sales revenue, this is sales revenue, okay, minus from the sales revenue, when you reduce your variable cost, you will get a contribution. Okay, okay, and this is equals to, and whatever the contribution amount, okay, whenever this contribution amount is, from that contribution we reduce our fixed cost, isn't it? So in that condition we'll get, either company get a profit or the loss. If the company's contribution is 1 lakh and the fixed cost is also 1 lakh, it means that the condition, that means there will be no profit and no loss situation. It means that whenever the company face no profit no loss situation, it is called as a break-even point, isn't it? So This is what a question is talking about when a company operate a break even point, the situation where company earn the no profit no loss situation. And this will happen, no loss situation, this is happen only when the company's contribution is equals to the company's fixed cost. This is a point where your contribution is equals to the fixed cost. It is called as a break even point. So right answer will be option number B will be the right answer, that is fixed cost. Okay, then moving toward the next question. Closing stock is to be valued at cost or the market price, whichever is lower. This is an example of application. So whatever the questions I'm taking over here, this we have done in the last session, last live class. Okay, so you can easily mark this question whenever we have an option, that is option number A, doctrine of the conservatism, option number B, matching concept, option number C, double entry principle, option number D, materiality concept. Okay, so the question is, whenever whatever the cost of that particular stock and the market price of that particular stock, and we consider whichever is the lowest cost, only that cost we write it down in our financial statement. So this is what principle the actually this situation in which concept we include, this concept explain, this process is included in which concept. Option number A, doctrine of conservatism, B, matching concept, C, double entry principle, and D, materiality concept. So what will be the right answer? It is your doctrine of the conservatism, because the conservatism system is talking about it, this is a accounting principle which that ensure that potential losses has to be recognized as soon as they are anticipated, and while whenever company face a gain in future are only recognized when only then are actually realized by the company. So here you see in this question, in the particular question, the valuing the stock at a lower of the cost as compared to the market price. So actually company want to avoid the overvaluing of stock, isn't it? So this is this approach we called as conservatism approach. Okay, so option number A will be the right answer. Okay, then moving toward the next question. The auditor has noticed existence of recurring losses on sale of fixed asset. This indicate that auditor has noticed existence of recurring losses on sale of fixed asset. This is option number 1, depreciation charge are insufficient, B, policy of sale or the disposal of fixed asset needed to be overvalued, C, the sale of asset has not been properly authorized, and D, there are the accounting error. First of all, whenever I'm talking about the recurring losses, so this is what recurring losses, it's kind of losses which is suffered by the company when they sell their fixed asset in the lowest value, that is recurring losses. And this losses suggest that company is selling the asset for less than their book value. Whenever companies sell their fixed asset in the lower than their book value, so this is recurring losses. Okay, and which could be due to the overvaluing the asset or the poor management. This is all happen because they do not manage, they do not depreciate the value of the fixed asset on the yearly basis. So it show that there is a poor management. Okay, so this indicate that company should review its policies. Okay, policy of sorry sorry for selling and disposal of the fixed asset needed to be reviewed. Okay, so this is the auditor suggest to the company. If they seen there is a recurring losses on sale of fixed asset, so auditors suggest to the company that your management are poor, you do not record your depreciation yearly basis, so you have to be attentive with your policies of the sales or the disposal of fixed asset, and you have to review it, isn't it? So company should be have to review it. So this is suggestions given by the auditor if in condition he notice some kind of recurring losses. And recurring losses, it is related with which is happen when there is a poor management of the sale of fixed asset, because they are not mention their depreciation value of the fixed asset on the yearly basis. Understand? Okay, this is so actually this is wrong here. Option number, this is wrong. The option number B will be the right answer. There's incorrectly writing right over here. Okay, this is wrong. Option number B will be the right answer. This is wrong. Option number B. Now lastly, now this question is started from the economic portion. Okay, we have completed over here accounting question, because in the last app live session we have gone through with the this accounting concept. Okay, then cash flow, fund flow statement we have seen. Okay, then what we have seen, what is the difference between the cash flow, fund flow. Okay, expenditure, revenue expenditure, then then the revenue receive, what is the difference between that. Okay, so we have seen this all basic concept. Now moving toward the next question, that is elasticity of demand for the necessity is. So this particular question is from the business economic. Okay, business economic section. So elasticity of demand, you know that for the necessity goods, so elasticity of demand for the necessity goods is equals to the 0, because here you can see the demand of that particular goods is static. Okay, but the price is where is going to be fluctuated, because this is a necessity goods, so that's why sorry it's equals to 0. Okay, demand for the necessary goods is equals to 0. This is wrong, this is wrong, we have, this is wrong. Necessary goods will be equals to 0. Okay, then moving toward the next question. Price discrimination is possible and profitable when the different market have price discrimination. As you know, what is the price discrimination? Okay, this is happen in the monopolistic competition. Okay, price discrimination, sorry, this is happen in the oligopoly. Okay, so this is price discrimination occur when the firm charge a different price for the same product or the services in the different market to the different consumer. The best example for this, that is, this is a price discrimination is how happen in the monopoly. Okay, so in the monopoly, the best example is railway. Okay, so in the railway you can see there is a you have want to go from Nagpur to Mumbai. Okay, but there are the different prices charged from the different person according to their facility, according to requirement. Okay, tier 1 AC, 2 tire AC, 3 tire AC, 1 tire AC. Okay, so this is the way they charge a different. We are going to in a same destination, all the persons are sitting in the train. Okay, they want to go in a same destination, but the railway charge a different price according to requirement and the luxury demanded by the people. So this is price discrimination, and this price discrimination is possible and profitable when different market have a different elasticity of demand, or the inelastic, if the elasticity is inelastic, it's not possible. Okay, this is wrong. Same elasticity of demand, not infinite elasticity of demand. So when this is possible only when the different elasticity of demand, okay, different elasticity of demand. Then moving toward the next question, that is, a seller can sell additional quantity of his price without reducing the price in. Option number A, seller. Understand the question. Seller can sell additional quantity of his product without reducing the price. Okay, he sell his product in the market, additional quantity of product in the market without reducing the price. So this is only happen when all the commands in the hands of one seller. Okay, and one seller, it's a condition where this condition and this market we call as monopoly market, because in the monopoly market there are only one seller in the market, and there are the many buyers who wanted to buy that particular product. So this is what will be the right answer, monopoly market. Okay, no, this is wrong. Perfectly competitive market is, it will not be right answer, because in the perfectly competitive market, you know the feature of that, there are the many sellers in the market, and there are the many buyers in the market. Okay, so how it is possible without changing the price they can sell the additional quantity? Is it not possible, na? Okay, so that's why option number C is not right answer for this question. Option number A will be the right answer. Okay, so for how to tackle this kind of question, how to solve this kind of question, if you are aware, if you are aware with the basic condition, basic features of each and every market, so you can easily mark the question answers, okay, of the particular question. Now an example of a drive-in demand. Okay, drive-in demand, we have option milk, money, manufactured goods, or fertilizer. What is the best example of the drive-in demand? So drive-in demand is a kind of demand, it refers to a demand of the goods and services that is not for the own sake, but because it is needed to purchase another goods, services. In this case, fertilizers is the only things that is drive-in demand. Generally consider this is demand, this is drive-in demand, actually is not needed by the farmer, but this demand is needed to be purchased only for the agricultural crops, okay, which are turned to be needed to meet the demand for the foods. Understand? And in the other hand, we also have the money. Okay, most of the people get confused in the money and fertilizer. Why the money is we not consider as the derived demand? Because money is a consider of medium of exchange. Okay, it is a medium of exchange, okay, which is not derived demand, which is basic necessity to live in this society. So this is not a driven demand, this is a basic necessity. Okay, so that's why fertilizer, this is not money again. Sorry for this, again it's mark the wrong, that is option number D, fertilizer. Okay, fertilizer will be the right answer. Then when marginal utility is negative, as you know, I am drawing over here, this is your marginal utility and this is your total utility, this is total utility. When your marginal, this is a point where your marginal utility is 0. Okay, when this is happen, when your total utility is in his maximum point. When your marginal utility is negative, is talking about the negative. So when your marginal utility is negative, that means your total utility going to be diminishing or decreasing. So option number C will be the right answer. Okay, okay, now moving toward the next question. To determine whether two goods are substitute or complements on an economist would estimate the, okay, first one, price elasticity of demand, B, income elasticity of demand, cross elasticity of demand, point elasticity of demand. Okay, so the question is that to determine whether two goods, suppose there is in a tea and coffee, okay, are substitute or complementary, and economists will estimate that goods, okay. So we study the substitute good, these are the substitute. Complementary, like here pen and ink, these are the complementary. Car and petrol, these are the complementary. Okay, so we study the substitute goods or the complementary goods, okay, in the cross, because they having the nature of cross elasticity of demand. Okay, so this is what your, we study all this concept, substitution goods and the complementary goods is it estimated in the cross elasticity of demand. Okay, because in the cross elasticity of demand we measure how the quantity of demanded of one goods, suppose tea, one goods responds to the change in price of coffee, price of another goods. If you see, there is price of coffees decreases, the people will moving, the quantity of people moving toward the coffee, that means quantity demanded is shifted to the coffee because price. So here the demand for the tea is decreases and the price of coffee is reduces when the demand of tea is decreases. Okay, this is happen. Okay, so that's why we study the cross elasticity of demand when we are talking about there is a substitute goods and the complementary goods. Okay, and what happened in the complementary goods, an increase in the price of one leads to decrease in the quantity of another. Suppose price of petrol is increases, so demand for the car is decreases, isn't it? Okay, people's moved toward the electricity car or the other options. Okay, so this is what, this is a cross elasticity of demand. Okay, now the next question, this one will be the last question of the today's session. First option, the assertion is given to be and reason behind of that. Giffen paradox rarely occur in the real world. Okay, Giffen paradox is rarely occur in the real world. Reason inferior goods are narrowly defined for which suitable substitutes are available. Okay, assertion is given, that is Giffen paradox. First of all, what is the Giffen paradox? Question is that. Okay, so Giffen paradox is the paradox which suggests that the price of an inferior goods, the price of inferior goods increases. The quantity demanded may also be increases, like is increases. So rarely occur, this condition has rarely occur in the real world. Okay, suppose they give the question, that is water. Okay, water is called as inferior goods because they do not have a value. Suppose there is a lots of shortage of water, so in that condition price of water is increases, and because this is a basic necessity, okay, so quantity is also going to be increases or decreases. Okay, so this is we study. Now reason is given, inferior goods. Given paradox study about the inferior goods. So inferior, actually what is not inferior goods? Okay, but I give inferior goods are narrowly defined for which suitable substitution are available. Okay, so which suitable substitution are available. So here your given paradox really occur in the real world. This is true, this is not happen in the real world, this is just a theory. When we are reason is given, inferior goods are narrowly defined for which the suitable substitutes are available, this is wrong, because reason behind of that, inferior goods are narrowly defined for which suitable substitutes are available, this is incorrect. In fact, given paradox is occur, there must be typically be no close substitute of the inferior goods. Okay, not the availability of the substitute. Okay, if the substitutes are available only in that condition, this is not fair. Actually this is substitute availability, it's a wrong when we are talking about the Giffen paradox, because Giffen paradox is talking about the no close substitute. It's give the stress on the no close substitute. That's why here the right answer, that is option number A is correct, but R is incorrect. So option number B will be the right answer. Understand? Okay. So student, we are ending the today's session over here. Okay. Hope so. If you want more question like this, okay, we have a 15 days strategy and we have remained 4 more session. If you want to be continue this kind of question, so you have to mark in the chat box, write in the chat box. Okay, so I'm ending today's session over here. Thank you so much, students.